Charlie Munger, who was Warren Buffett's business partner, used to say that to succeed in fishing, you need to fish where the fish are. If you are looking to make your money work aggressively and you are not too sure whether to invest in big established companies or smaller up-and-coming ones, this video is for you. I will explain you which type of stocks you should focus on if you manage less than $1 million and follow a Buffett-style investing. If you stay until the end, I will share with you one caveat to consider if you are sold with this approach. So let's dive in! When it comes to investing, there are a lot of things to think about, like the size of the companies you want to invest in. The big companies like Meta, Apple, or Amazon are the ones most investors are all about. Here's the thing, those are not the best bets if you manage less than $1 million and want to make your money work aggressively for you. So here's the question, which company size should you focus on to make the most out of your stock investments? I think that putting your money in fast-growing mid-caps is a smarter move to grow your portfolio if you manage less than $1 million and follow a Buffett-style investing. A mid-cap company is one with a medium-sized market capitalization. In the US stock market, every company gets categorized based on its market capitalization or market cap, which is just the total number of shares available to buy multiplied by the current stock price. Mid-cap companies are those with a market capitalization between $2 billion and $10 billion, and I think that they should get all your full attention when making your investment decisions for the three following reasons. Reason number one, they offer better growth potential for your investments compared to mega caps. Reason number two, they offer more opportunities to find undervalued stocks compared to mega caps. Reason number three, they have a better risk profile than small caps. Let's go through those points one by one to understand them better. According to Peter Lynch, who was one of the best investors in the world, in the long term, the price of a stock follows the earnings of a company. If strong future earnings are what really drive a stock's growth, then investing in a fast-growing mid-cap has two big advantages. The first one is investing in a company that makes more money than its competitors. The second one is investing in a smaller company that can keep making good money for a long time. All this means that there's plenty of room to grow for the company to keep making good money for its shareholders for a long period of time. When a company gets bigger, it's really hard for them to keep growing as quickly as they did when they were smaller. If it has penetrated most of the market it operates in, its sales and profits can start suffering because there is not much room left to grow and get more customers. This could negatively impact its stock price if its earnings start dropping. When you invest in a company before it has totally taken over its market, your money has more room to grow aggressively. And mid-caps give you the best chances because they are still growing. If they have got a lot of room to grow, investing in a fast-growing mid-cap company at the right time is like catching a great wave while surfing. Surfers paddle and position themselves just right so that when the wave reaches its peak, they catch it at the perfect moment. All the time spent before catching a wave is focused on spotting good waves in the distance. Similarly, investing in a fast-growing mid-sized company means finding one with a strong growth potential before it becomes too big and mainstream. When you invest at the right moment, you ride the company's momentum as it expands its market share and profits. You benefit from the company's momentum to make big gains on your investment. In addition to offering better growth potential, mid-caps can also be priced at an attractive discount based on their value. Mid-cap companies usually get less attention from analysts compared to big names like Amazon or Apple. This lack of attention from analysts can lead to less accurate pricing of mid-cap stocks. This can give you the chance to find undervalued stocks that have been ignored by the wider market. On top of getting less attention from analysts, those stocks are not that appealing for big investors until they become big in size because they are not big enough to make an impact on their portfolios. As of December 2023, the size of Warren Buffett's portfolio is $350 billion and is sitting on a cash pile of $170 billion to invest. If he invests $5 billion in a mid-sized company and his investment doubled to $10 billion, the $5 billion gain represents 1% of his portfolio size and the cash he's sitting on. He has said in the past that if he had less money to manage, he could be making a whopping 50% return per year.
True. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation, if they needed it. I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or $1 billion, at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith interview a few years ago, if you start with A and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you can, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds.
The opportunity offered by smaller stocks can be much more difficult to find if you are only focused on mega caps. When compared to mid-sized companies, the big ones are usually well priced or even overpriced because they attract most of the money in the stock market. The high demand for those stocks mainly comes from the attention they get and the focus of big investors that can structurally only invest in them. Sometimes, this can make it hard to buy those stocks for less than they are worth. While mid-caps can be easier to buy for less than they are worth, they also offer better protections compared to small caps. Value investors like Warren Buffett see risk as the permanent loss of the money you have invested. This can happen if the company you have invested in goes bankrupt. If we look at fast-growing mid-cap companies, they are often more established and have a longer financial and operational track record than small-cap ones. They might have solid business models that already allow them to maintain strong profits compared to small caps. Those operational and financial track records sometimes have been maintained for a long time. Some of them might have been in business for decades. Ollie's Bargain is a discounted store that has been around for 40 years. It's a fast-growing mid-cap that has proven its business model can withstand major market disruptions like the internet bubble in 2000, the global financial crisis in 2008, and the recent market crash caused by the pandemic in 2020. A small-cap company could struggle more during big market shakeups, especially if they are not profitable yet and are not showing strong operational and financial strength. If focusing on mid-cap companies can boost returns in your portfolio, you should not ignore mega caps entirely. It's important to mention one caveat if you are sold on investing in fast-growing mid-cap companies. Some mega caps can become super cheap when they face a short-term issue. If the majority of investors rush to buy them, they usually rush to sell them when they experience a short-term issue that makes the front page of the news. In this situation, if the price of those mega caps is attractive and they become undervalued, you should seize that opportunity and invest in them. Meta is a great recent example. Its stock price fell from nearly $350 in November 2021 to $100 in November 2022 because of a short-term problem. This issue is behind them now, and nearly 16 months later, their stock is close to $500. If you had invested $10,000 in Meta in November 2022, that investment would now be worth nearly $50,000 by the end of March 2024. If you want to learn a way to shortcut your stock research process, you will find on the screen a video I recently made on that topic. This is it for today, guys. If you got some value from this video, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out.